Promised, here's Jonathan Garner of Morgan Stanley joining in to talk about what's been a pretty sizable rally for equity markets. Jonathan, morning. Good to have you on the show. What have you made of this substantially large rally for equity markets, and do you think it can get extended?
We made quite a controversial call at the end of last year. We said that we thought the trough was already in on the 27th of October for the emerging markets, and that emerging markets would trough before developed markets, and it's increasingly looking like that happened, with the S&P likely having troughed at the beginning of March. Indeed, we've had an Asian-led fight back, which is what we were looking for in the markets. And the reason this happened was we moved to egregiously undervalued levels. Last October, we briefly traded at a price-to-book of 1 for the MSCI EM index for the first time since September 1998. And yet the underlying fundamentals in the emerging world, particularly the ability to engage in self-help, that counter-cyclical policy action I just talked about, is much bigger than in 1998.
What about the data points in terms of recovery, both for economies and for stock markets, and do you think that is likely to stoke risk appetite?
Well, obviously, we're not out of the woods in terms of the global economy. Our house forecast is for a muted global recovery in 2010, but we've almost certainly passed through the worst 2 quarters for global economic activity now. And particularly in the emerging world, there's a chance that we will have a sort of last-in, first-out situation, most notably in China, where there's quite evident re-acceleration if you look at the China PMI being back above 50. This is all consistent with the kind of things that encourage people to take more risk appetite and to extend their duration in terms of their investment horizons. So I'm pretty optimistic, as I said, that we've actually already seen the lows for this cycle.
What about India? Where does India fit into that puzzle, Jonathan?
Well, I think if you look at how people went into this, both India and China in late 2007 were in something like bubbles on the valuation side, so they both needed massive unwind of bubble valuations. The good news is that that was complete, in my view, by early March. India lost all of its valuation premium to the rest of the asset class. Unfortunately, most GEM investors, global EM investors, did not shift to an underweight position in late 2007, which was what we recommended at the time. We ourselves were just closed out that underweight, and it's good to see the Indian market starting to catch up with the rest of Asia.
We are about to enter an earnings season as well here in India. What do you expect from fourth quarter earnings? And given earnings, which sectors would you keep your relative overweight bias in India now?
We expect a modest sequential improvement. We're still going to be in negative year-on-year territory, and we're still pretty cautious on sectors like the industrials and indeed parts of the banks universe. So our preference within the Indian market is still somewhat defensive, more towards the telecom, pharma, consumer staples area. But as I said, at the aggregate level, trading around about 11 times this year's earnings, that's not an expensive market.
There has been some nervousness as well for India in specific about elections as an event. How do you read that?
Usually in emerging markets, stock markets are volatile ahead of elections, and this one's particularly difficult to call the outcome of in India. We have some fluidity in the political alliances. The chances are of a multi-party coalition government, and so one has a degree of uncertainty as to how policy will evolve after the election. And it's important that India does move forward on the policy front. But I would suspect that the deeper point is the underlying global economic situation I talked about, and the fact the market is now properly priced.
How are you reading the rest of the year then for India and for emerging markets, Jonathan? Do you think the worst is in place and we made a bottom in March, or do you see the possibility of a retest of those lows being pretty high in 2009?
When we wrote on the year ahead, we said we thought we'd already seen the low for the year on 27th of October. We highlighted the risks of revisiting the lows during Q1, and indeed if you look at the Indian market, that's what happened, less so on the broad EM index. But we have seen since the end of Q1, particularly with these accelerated monetary policy measures and things like the G20, that risk appetite has returned. So as we sit here today, I'm pretty comfortable with the proposition that we can make further progress from here. We're still trading in single-digit trailing PE for the MSCI EM universe. We're tracking earnings quite carefully. At the moment, they're in line with our forecast of down 25% for the year, with likely a recovery in earnings in 2010. So, so far, so good. There's no reason to get incrementally more bearish here.
Jonathan Garner, appreciate you taking your time out. That's the head of emerging markets at Morgan Stanley, telling us that he believes the worst is in place and it's time to get constructive on emerging market equities. With that,